Today I'm going to talk about dividend-paying stocks and what dividends mean to you, the investor, because this is something we hear all the time about a search for yield. And well, what's the yield on this this particular stock, or what's the yield on this bond? And as interest rates have shrunk and it's so low and retirees are counting on income, I think there is often a misunderstanding about really what a dividend is, particularly when we're talking about stocks. So I want to give you a real world example of how it works. So IBM, a company that we all know, back in August of 2014, closed at $187.10 per share. It paid a dividend of $1.10, and then it opened at $185.36 the next day. It did this, but that's actually a little lower than $1.10 less than this number because of what aftermarket trading or whatever happened after the market closed. Everything being flat, this $187.10, taking away a $1.10 dividend, would leave you a $186 share price, and that's the way it works with every single security. There is no flat, and it's just going to pay you this dividend and the share price is going to stay the exact same. It is coming out of the cash per share and going to the investor, and the share is decreasing by that price every time. So if you are only pursuing a dividend paying strategies, there are some really significant flaws associated with that. The main thing that I see is a lack of diversification. So what you're doing by just, let's say if you're buying all the dividend stocks, you're excluding 40% of the global economy, obviously a very large chunk, which is not dividend paying securities. In the United States, dividend-paying stocks have decreased substantially. This is in 1991, 71% of companies were paying a dividend. In 2014, only 61% are paying a dividend. And then you look at diversification throughout the globe, and you see that 92% of Japanese stocks pay dividends, whereas only 38% of Australian stocks pay dividends. And then there's been a premium associated with investing in small companies, and only 47% of small companies pay dividends. So you're excluding 53% of small companies, which has historically given you a substantial return over time. So the question then becomes, well, what should I do? And there's nothing wrong with companies that buy dividends. We say you should own all those, but you should also own the other ones that don't. And what this is going to do is, if you need a specific amount of money coming into your account every day or every month because you're retired, you can create a synthetic dividend. So then you start selling shares to pay yourself, and it's more tax favorable. It gives you more control versus relying on a company to pay a dividend and thinking that it's some sort of guarantee that your principal is never going to be touched. So you have more flexibility, more control over what the cash flow is, and then also over taxes. Sometimes you can sell securities at a loss and not pay any tax, or you can control whether it's short, long-term capital gains, where the dividends are going to be taxed at a flat rate, whether you're making money or losing money on that security. It doesn't matter at all. So giving yourself more control by creating a synthetic dividend, to me, is a better way to go than this searching for yield, this seeking out stocks that happen to pay a high dividend. It's not guaranteed, and it's not as if you got a stock $100 and it pays a $5 dividend, it stays at $100. It's going to 95, and you hope that it eventually will come back up. But if you focus on the total return instead of just the yield, you're going to be much better off. You are more diversified. You don't have any less return over time. Historically, it hasn't shown us that dividend-paying stocks do better than non-dividend paying stocks. So you're more diversified. You have less. You're going to have less control if you're just counting on that. There's no guarantee that a dividend is going to be paid forever, as we saw in the 2008-2009 financial crisis, where many companies started cutting their dividends as their cash flows decreased. So creating this synthetic dividend gives you more control, puts it back in your hands, going to manage your taxes, make you more diversified. You're really not giving up any expected return in the future. If you have questions about this, go to our website, call me, 770-984-2312. Have a great day.